Why is demand of labor so important to jumpstart our fear of inflation?
Well, to get an ongoing inflation problem, not just the little bubble that we're experiencing right now from reopening and supply disruptions, you really need to have pressure on resources, and pressure on resources starts with labor. It's probably premature to expect a real inflation problem right now because we still have a lot of people out of work because of the pandemic. If you look at the level of payroll employment right now compared to where we were in February 2020 before the pandemic started, we're still 8 million jobs short. And we're also not seeing much in the way of wage pressure. While wage pressure in the first quarter was a little bit firmer on a year-over-year basis, so wages for private sector workers are only up 2.8%. It's hard to have much of a inflation problem if wages are still quite quiescent.
Dr. Dudley, how do you overlay this different American economy? Lisa alluded to this earlier, but to me, it's simply an exercise in technology and an exercise in concentration of jobs growth, almost monopsonistic. How do you overlay technology onto the American fears of inflation in 2021?
Well, technology is obviously changing work habits in quite a way. It allows people to work remotely. And so we're going to see a wholesale change in how people work, I think, over the next few years. How much we go back to the pre-pandemic mode of working, I think remains to be seen. I think the problem right now is that you have a lot of people who are not actively seeking work because, they have childcare problems. They're worried about getting sick, or they just may, their businesses may not have been reopened yet. But I think as the economy reopens, a lot of these 8 million workers that are still out of work will become available again.
Bill, how much control does the Fed still have over inflation?
I think they still have control in the large, in the sense that they can control how fast the economy grows, how tight the labor market becomes, and that ultimately drives inflation. They can't in the small. I mean, obviously, the supply disruptions that we're seeing right now, Fed can't do very much about that. The big spike you saw, for example, in used car prices, that's a confluence of two things. One, chip disruptions that are limiting new car production, and two, demand for cars by rental companies who are starting to get back in business again.
But it raises a question for the reaction function of the Federal Reserve. In other words, how much they can actually effectuate change or some sort of decline in these prices should it start to tighten policy. It perhaps isn't a first step toward tightening policy, but the Fed is going to unwind its nearly $14 billion portfolio of corporate debt and corporate debt ETFs. Was this policy a template for how the Fed will handle other additional market situations going forward?
I think what they're doing with the corporate bond portfolio is pretty unrelated to the whole notion of monetary policy tightening, because it's actually a very small portfolio in terms of size, and it's not something that they typically own as part of their portfolio mix. So I think I would not take that decision as implying anything about the timing of taper and the timing of actually lifting off and raising short-term interest rates.
Bill, does the Fed, though, actually really want to see that target hit? Because we get a lot of talk out of the Fed about how this is transitory. There seems to be this general sense here right now that if expectations themselves don't rise, you basically don't get there. You look at market pricing right now, we're somewhere around about 2.3% or so on five-year forwards right now with regards to inflation expectations. That's pretty much in line with what we've seen over the last 10, 20, 30 years as far as averages go here. Expectations, at least among the market, really hasn't risen despite all of the anecdotal evidence we have on the ground that inflation is here and it is real.
The Fed is actually happy that inflation expectations have risen a bit because they were actually pretty low going into the pandemic. And this is one reason why the Fed has changed their long-term monetary policy framework to target 2% inflation on average rather than 2% inflation at any point in time. They want to keep inflation expectations better anchored, and this increase that we've seen in inflation expectations, which is pretty modest, has better anchored inflation expectations around 2%. So they're pretty comfortable with what's happened in that respect. They're probably happy about that as opposed to unhappy about that. You're absolutely right, though. If inflation expectations are well behaved, it's really hard to get an ongoing inflation problem. So my view of it is it's really about the labor market, tightness in the labor market, that driving up wages getting into prices. And then does the increase in prices start to affect inflation expectations? I think that what we're seeing now in inflation is going to turn out to be transitory. But I think there could be a longer-term inflation problem just because the Fed's monetary policy regime is a different one now, where they said that it could be very, very slow to lift off from zero in terms of short-term interest rates.
I'm curious as your thoughts on the wage situation, the wage inflation situation, particularly because we actually saw wages, at least as far as their historical averages, hold up pretty well during the COVID-induced recession here. The idea here that we would see some sort of meaningful appreciation above the whatever it is 3% plus rate that we've been at here, is it even possible, given that we're coming off such of a relatively high floor, that we would see a meaningful bump up in wage inflation?
I mean, it's possible, but it's hard to imagine a big wage inflation spiral at this point in time, given that you still have 8 million jobs short of where you were going into the pandemic. And the unemployment rate itself, even though that doesn't suggest the labor market that's that tight, 6.1% unemployment rate is still well above the 3.5% rate that we reached in February of 2020.
Bill,
It seems like there's still a lot of labor market slack.
before we let you go, Bill, we're talking about AMC today. Is the Fed responsible for frothy markets?
I think the Fed is responsible for creating a monetary policy that's very conducive to lifting financial asset prices. But, the AMC phenomenon, I think, is something that I would not lay at the feet of the Fed.
Bill, we'd like to get more of a quote from you than that on AMC. I mean, Bill, do you think regulation's got to step in here? I mean, this is unusual, to say the least.
Well, I think, this is a question where, I think people need to think about what's fundamental value and what's the stock price relative to fundamental value. So buyer beware. I guess that's the way I would put it.